Welcome to the Major League Real Estate Podcast, a podcast for operators of large-scale real estate portfolios. My name is Nathan Sosa, and I'm your host. Together with my co-host, Matt Hamilton, we talk about tax and legal strategies, and we bring on operators of large portfolios for in-depth discussions on how they grow their business. We hope you enjoy. Welcome to another episode of the Major Real Estate Podcast. Matt, how are you doing? I know, we said a couple weeks ago that we're talking about how it's so cold. And that it's so cold in the South/Midwest area. Interesting discussion, actually, is do you think Missouri is the South or is it the Midwest? That's kind of a big question that people get a lot.
Yeah, I mean, that's it's kind of an interesting question. I would say Missouri is geographically in the Midwest, but Southwest Missouri and the southern parts of Missouri are more culturally part of the South than the Midwest. But for what it's worth, I'm actually 20 minutes across the border into Illinois, and Illinois is firmly the Midwest, I would say.
I totally agree with that. The one that people are always confused on is Oklahoma. People never know what to say about Oklahoma. I know. Well, so if you obviously you are close to Oklahoma, you're oh yeah, it's the South. But if you talk to other people or some even Oklahomans, they're I don't know. I think we're the Midwest. And I was I don't know if you can say that. I'm pretty sure we got very Southern cultural vibes here.
Yeah, it's very Texas adjacent. It's Texas's hat for all intents and purposes.
Which Oklahomans listening now are not going to be happy hearing that comparison, because we have the feud with Big Brother Texas that we always like to have, right? It's and then they have Oklahoma football, Texas football, and so the Big Red River rivalry. So they're
Sure.
We love to think that we're better than Texas. I'm not going to comment on that point at this moment. Because it's I don't know how many Oklahomans are listening right now, but speaking of that too, actually, wearing my Thunder hat today. Last week, we talked about the game, and Thunder won, right? They won a big comeback victory, and then, last night, they got blown out. So that's not super great. By the time this airs, probably Game 7 will have happened, and we'll find out how the series ultimately went. So I don't know. Hopefully, by the time you hear the next podcast, I'll either be very monotone and humdrum, and you'll know that the Thunder lost, or we'll be super upbeat, which means we won. We got the first finals in OKC history.
Well, for what it's worth, you'll be more than just upbeat. I feel you'll just blatantly say hey, just the Thunder won. What's the series at right now? It's
3-3. Game 3-3.
Right.
Yeah. So it's Game 7. Game 7 home in OKC. Tickets go for $1,100 at the literally your back's against the concrete of the stadium. That's you don't get a chair rest. You should have concrete back. Yeah, it's not cheap. If you want, I was looking at prices just for fun. A box, which is 18 seats, goes for $100,000 right now.
Oh my god!
Which winds up being $6K a ticket.
Okay, well, when you break it down like that, I guess it's not that great.
Okay, but still, $6K a ticket is not cheap.
No, that's not cheap. And the Thunder is the only professional sports team in Oklahoma City, right?
Yeah.
Yeah, that'll do it.
It will definitely do it. We'll see. I know people people are talking about whether or not they're going to jump in there. Hopefully pull it out and they win. Back to the Heat, man. It's super muggy. It's just so hot right now.
Yeah, no, I'm getting new windows in my office on Monday, which is very exciting because it's 1,000,000 degrees in here right now, and I'm sweating profusely. I don't know if you can see my face glistening on the recording, but it's getting warm in here. So I'm hoping that the new windows will keep it cooler and I can get natural light in here without baking myself alive. So that'll be really exciting.
Yeah, just know, guys, when Matt does this podcast, he's really just doing a service to all of you, because he's baking himself at the same time.
Yeah, you're welcome.
So speaking of hot topics, a hot topic of the summer, Matt, is allocations in a partnership. Specifically depreciation allocations, right? Everyone has questions about that. How can I get more depreciation? How can I get less income allocated to me? That's the game everybody wants to play. But honestly, I think that's the wrong place to even start. We shouldn't even start with how do you do the allocations, et cetera. We kind of have to start at an even baser level and talk about capital accounts. So we talked about that a little bit on episode 1, what capital accounts are, but what are capital accounts and why do they matter for allocation purposes in a partnership?
Yeah, so capital accounts, very simply, are a means of tracking a partner's basis in an investment in a partnership. And very simply, they increase by either contributing cash or other assets or being allocated taxable income. And they decrease by being distributed cash or being allocated losses. And that's very simply what your capital account is. And it's really just a means of tracking your tax basis. Very much like how you would buy a stock and you have a basis in a stock and you sell it for a later date. And then your capital gain on that sale is the difference between what you sell it for versus what your tax basis is. It's very similar. It's just a different mechanic for tracking that in a partnership.
It's probably fair to say that capital accounts are basically how everything's run from a partnership / sub K level, right? Like, it is the bread and butter of it. And one thing to note too is that if you have a negative capital account, that does not mean that you have negative tax basis, right? Like, a lot of times you get that question, a lot of people think that, or think, oh, I have negative basis. Like, well, those are very separate topics. So just an FYI there, but it's still important to know when you have a negative capital account, how did you get there? Why did you get there? And all that happens through the partnership allocation. So Matt, I guess then, like, how can you get a negative capital account? And what does that mean if you have a negative capital account ultimately?
So you would get a negative capital account very simply just by being distributed cash, or, well, actually backing up. If your capital account is increased by contributions of cash or allocations of income, and it's decreased by distributions of cash or allocations of loss, very simply, it means that you've been distributed cash and or allocated losses in excess of the cash that you've put in or in combination with the income you received. It really just means that those two things are offset in a negative balance where you've just gotten more out of the partnership than you've put in.
I think that's a great way to think about capital accounts, because, like, I'll say there's a lot of confusion about it. It's like, oh, like, tax and capital accounts are the same thing. I love what Matt said, is that basically it's almost like your checkbook, right? It's like, hey, what you've put in, what you've gotten out, the income you've received or been allocated, that's all netted there. And so if, like, you have a negative $100,000, that means if you put in 50, it means you got losses and or distributions of $100,000 ultimately, right? So that's kind of a summary of that. And, like, a way to think about that is like, hey, your capital accounts is going to be the net of what you've either put in or the net of what you've taken out ultimately, right? Like, one day we'll talk about the allocations of debt and how that plays into our tax basis, which is totally different, right? Even though that will show up on your K1 right above your capital account, but that's something totally different. So capital accounts are our base, right? If that's how we build everything off of our allocations distributions, then what do we do next? How do we use those to determine who gets allocated what in a partnership?
So partnerships are, first and foremost, a very popular tax entity, specifically because of the flexibility and freedom they grant the operator. So every partnership is going to have what's called an operating agreement, or an OA, as you might hear it referred to as. And in that operating agreement, there's a lot of legal information in there. We're not attorneys. We can't really speak to a lot of the information in there. It's, how the company is run, what recourse you have if certain things happen or if anyone tries to sue you. We're not going to talk about that. But there's always a section in there that talks about how the taxable income in the partnership needs to be allocated across all of the partners. That's always in there. And there's always a section. Well, I don't want to say always. There should always be a section in the operating agreement that outlines how the cash in the partnership will be distributed across all the partners during times of operation and during times of liquidation. So those are the three important components when we're looking at specifically the tax piece of this partnership. And in that tax allocation section, the partnership really gives you the freedom to kind of write whatever you want. Oftentimes how you'll see this written is tax allocations, and then taxable income will be allocated amongst the partners in X, Y, and Z way, and tax losses will be allocated across the partners in ABC way. And then there's always a section right after that, it's boilerplate language that says the allocations in this partnership need to conform with Section 704 of the Internal Revenue Code and the related Treasury regulations. And if what I said before this doesn't conform to that, then ignore everything I just said and make them conform. That's the boilerplate language that every attorney is going to put in these operating agreements just to cover our bases and make sure that it conforms to the Internal Revenue Code and IRS guidance. And we'll get into that in a second, but that's just kind of an outline of how these allocations work and some of the freedoms allotted to the operators of the partnership.
That's a great breakdown. I'm trying to think of a good way to summarize that. And it's essentially that partnerships provide tons of flexibility. There's a lot of opportunities that you get to have in there, like who gets allocated income, who gets preferred capital, preferred returns. But ultimately, we have to live under that provision that you just mentioned, 704B. if the operating agreement, the PPM, right, those two documents, if they don't align, if they don't follow 704B, then we have to basically throw it out the window, right? Then it's like everything doesn't matter. And so what even is 704B then? So like, okay, so like I know that's like everyone's going to hear that. Like the only reason I'm saying that is because like if you read your operating agreement and you go to the tax section, you're going to see 704B mentioned basically probably in nearly every provision or at least once per provision. And so why do we care what 704B says?
So I'm going to answer that question with a big caveat in front and saying that Section 704B and Section 704C of the Internal Revenue Code is quite possibly the most complicated section of the entire Internal Revenue Code. It gets very complicated very quickly, so I'm going to try to skim this at a very high level just to try to keep this as simple as possible. But a lot of these sections and the related Treasury regulations and IRS guidance all kind of work in tandem to say one high level thesis across all of this, and that is that the allocations in a partnership need to follow the economics of the partnership, or in other words, they need to have what's called substantial economic effect. And what that means is that the income or loss that the partnership generates needs to be allocated to the partners that effectively received the economic benefit or the economic loss associated with that activity. So just a really simple example. Let's say you and I start a 50-50 partnership and I contribute $1 million and the partnership uses that $1 million to operate the business. And you have the skills necessary to run the business. So I'm not involved at all. I've contributed $1 million. I don't run the business day to day. You are the GP, the operator that's running the business and making the business profitable, hopefully. But let's say a year down the road, the business, unfortunately, is not profitable. Let's say that this business that I put $1 million into generated a loss of $250,000. Now, there's only two partners, and that $250,000 of loss needs to be allocated to someone. It's either you or me. But you didn't put any capital in. Your capital account is zero. And hopefully, if the partnership generates profits, eventually you get to share in that profit because you're working as the operator of the business. But for right now, you have nothing at risk. You didn't put any capital in. You could leave tomorrow and you didn't lose any money. I, the person who contributed $1 million, I'm the one with capital at risk, and I am bearing the economic loss of this $250,000 loss that the partnership generated. Therefore, I need to be allocated all $250,000 of that loss. And that very simply is how tax allocations in a partnership would follow the economics of the deal.
Real estate syndication tax is confusing to you? Well, that's why hopefully you listen to the podcast today. Also, you should go to our website, www.therealestatecpa.com, and you will be able to get access to the ultimate guide to real estate syndicators and sponsors, which breaks down everything from preferred returns, depreciation strategies, whether you're a GP or an LP, avoid costly mistakes, and maximize your returns. Download the complete guide free and get the tax clarity you need to succeed. Yeah, it's a great breakdown, Matt. It feels like a lot of people talk about partnerships being really flexible and being able to do whatever you want. I don't think that's the case here. It's like clearly not the case because it comes down to, like you said multiple times, the economics. Who put in the capital? Who is at risk here? And a quick summary of that is like, look, if you're not putting anything up, if you don't put any risk, if you don't have anything here and you're just running the business, you're not going to get a lot of the losses, unfortunately. That's just the way it is. The tax code is very, very specific and really has different treatments for people who are the ones who are the capital providers and capital raisers versus those who are actually minding and grinding the business, right? Like, so that's why it's difficult for a lot of general partners to receive a lot of losses that we see a lot, right? Because maybe they didn't put in any capital contributions. Maybe they're just the ones that got everybody together and they're going to run the real estate. They're going to take care of it. They're going to do all the acquisitions. Great. But they don't have any real capital at stake. And so because of that, the tax code goes, okay, great, no problem. But you're not going to receive any of the losses that exist here. Is that a good way? Like, would you have any caveats there?
Yeah, no, I agree with everything you just said. The only thing I do want to add is that while it is a challenge to be allocated losses as a GP or an operator that is not putting any capital into the deal, it's not impossible. You just have to shift the economics. And this is the pitfall that a lot of people run into, is they'll say, well, I want to be allocated losses, so I'm just going to write that into the operating agreement and say that like tax income and losses are going to be allocated to partners pro rata, but all the depreciation is going to be allocated to me, the GP. You can write that. But if you don't shift the economics of the deal to create that actual economic risk for yourself, you're not going to be able to substantiate those losses. And if the partnership were to be audited by the IRS, there's a very good chance that they would disallow those loss allocations and make you amend the return.
And that's what we always got to think about, right? I understand audit rates are very low and some people think they can get away with stuff. But guess what? Is you do have the IRS come knocking down your door 3 years from now and you have to go substantiate that. It's not a fun situation. You have to amend and reissue returns and K1s to all your investors here. Like, this fund ended 3 years ago. I didn't expect to get any of this, right? Like, what's happening? Why is all this occurring, right? That's not a fun situation to be. And I totally agree. Like, I'm glad you pointed that out too. Is that, yeah, it's difficult to try and allocate depreciation or even like full amounts of losses to general partners, but it's not impossible. There are ways we can do that with items like deficit restoration obligations. DROs are definitely a way that people can take these losses. But before we even dive into that, let's talk about what happens if, because I think it's really important, it's in every single operating agreement, and it's how most partnerships run, most partnership syndications run today, is that we talked about going negative in your capital account. What happens if you go negative in your capital account now, but then you have other partners that are positive or at zero? What happens in those events?
Yeah, I mean, that's a great question. So generally speaking, in a partnership, no partner can have a negative capital account while other partners still have a positive capital account, with the exception being if there's a DRO, which again, we're going to chat about at a later date and get more into those details. But in the absence of a DRO, no partner should have a capital deficit unless all of the partners have a capital deficit or are at zero. So all capital accounts need to be positive. They all need to be negative or at zero. There's no in between. So in that scenario, well, I guess why would someone have a capital deficit if other partners still have positive capital accounts? And usually this comes from being distributed cash in excess of your capital account. So if you have $100,000 left in your capital account and you're distributed $150,000 of cash, obviously it's going to put you into a negative capital account scenario. The other one being erroneous allocations. If you just sort of ignore the 704B section of the operating agreement and just kind of allocate pro rata or whatever and create these issues where some people have positive, some people have negative capital accounts, that's the other scenario. But when this happens, every single operating agreement I've ever looked at without fail, right after the section talking about 704B, or like in that section, it'll say that in a scenario when it becomes necessary, or in a scenario where someone has allocated losses in excess of their basis, we need to do what's called a qualified income offset, or a QIO. And what that effectively means is the person with a negative capital account needs to be allocated additional income to get their capital account back up to zero. So in practice, let's say there's that person who received $150,000 of cash over their $100,000 of income. That means that they would have to pick up an additional $50,000 of income to get their capital account back up to zero. And really what that means is you received cash in excess of your basis, so you have to pick up income for the cash that you received that you didn't have basis for. It's just kind of thinking about it like that, I think makes it a little bit simpler to comprehend. But that's kind of how we would handle that situation.
Yeah, this is not an easy topic whatsoever. But I guess like a quick and dirty way to summarize that, Matt, is maybe to like think about it as like, look, if you go negative and you have other people go positive, you got to make that up somehow, right? And the two ways that you make that up on a capital account, there's only two lines, right? If you look at your capital account, there's two lines. There's income and there's contribution. So you either got to put money in or you got to get taxed on extra income. So if you pick and choose your poison on that one, but it is literally required to be fixed. And some people might say, well, my like, I've never seen that happen before. Well, it means maybe you're not necessarily in correct compliance. And that's okay. Those can be fixed. Matt said to me the other day is that partnership allocations are an art, not a science. And so like, and I think it's really a beautiful way to put that, because partnership allocations are not the easiest thing in the world. And actually, like he said, the art, not a science, that actually leads into you need qualified income offsets or a deficit restoration obligation, which we're not talking about today because holy cow, that's a whole different can of worms we can open up. There's actually another kind of way that we need to achieve substantial economic effect, I think, with partnership allocations. And that's with targeted capital account allocations, right? And like too many A's. Matt, what are those? And why are they actually really applicable in syndications?
Yeah, so when you're looking at allocations, To create substantial economic effect, tax allocations need to do one of two things. The allocations need to follow the cash flow. So that way, the cash flow and the cash distributions represent who is benefiting from the economics of the partnership, right? So if the allocations follow the distributions, then by default, it has substantial economic effect. The other option would be to do the reverse, where you just very simply have the cash distributions follow whatever the allocations are. And what doing that does is force substantial economic effect to happen. Out of all the partnerships I've looked at, the former is much more common, to just have allocations follow the distributions. That is what a targeted capital account is, and that's kind of what you were alluding to earlier. It's very popular language that I've seen in a lot of operating agreements over the last couple of years. And effectively, all it says is that at the end of the year, every partner's capital account has to, as closely as possible, reflect the amount of cash that they would theoretically be entitled to if the partnership were to liquidate on December 31st. And in order to get those capital accounts up or down to where they need to be, you need to effectively back into that calculation in the income allocation on each person's K1 is the plug to get their ending capital account to where it needs to be, which is a very complicated process. As you can imagine, just based on what I described, I'm sure that was difficult to follow. It's because it's kind of a complicated subject. But very simply, it's a very popular method of forcing substantial economic effect through language that is much easier to draft in an operating agreement.
Definitely hard to follow for sure, just because it's so complex. I was thinking about it, like, basically we know what our number is at the end, right? So like, I guess what I think about is we know what our capital account number should be at the end of the year. And it's basically like, let's just figure out how to get there between beginning and end of the year, right? With capital allocations, right? Like, I guess that's the easier way to think about it, is that like, hey, we know what the ending capital account number is supposed to be based on the operating agreement. So that's what we flow through, right? It's like, that's kind of like the way I like to think about it sometimes with targeted capital accounts. And like, and Matt, again, like, why are they so popular? I know you kind of touched on that, but I want to like really dive deep into this. Like, why are these so much more popular than other provisions that are out there?
It's really popular specifically with syndicators because basically what it does is it forces the allocations to follow the liquidating cash waterfall. And we can probably get into this more at like a later date just because it's a whole kind of separate topic. But at a really high level, what a cash waterfall is a system in which cash needs to be allocated once the partnership dissolves and liquidates. So the partnership, they sell all their assets, they pay off all their debts, and what you're left is the remaining equity. So assets minus liabilities, that gets you your remaining equity. And the waterfall basically outlines how that remaining cash needs to be allocated to all of the owners. So just a very simple example, a very common example. The first thing that needs to happen is all of your LPs need to be paid a preferred return. That could be 5, 8, 10, 15, 20%, whatever you outline. First thing that you need to do, you need to pay their preferred return. Then you need to return their capital. And then at that point, you can split the remaining cash between the LPs and the GPs, 80-20, 50-50, 90-10, however you want. There's a lot of flexibility there. But that is a very simple 3-step example of what a cash liquidating waterfall is. And what targeted allocations do is they effectively run that waterfall calc and determine how much cash each person is entitled to. And we plug the difference to get their capital accounts to represent that number.
Sounds like an easy way to back into the ultimate number at the end of the year. And so it sounds like it's a little bit more simpler from an accounting perspective, probably a legal perspective, and then also just for investors to understand too. Matt, I know we've talked a lot about liquidations and stuff today. Is that like partnership tax is kind of syndications are all done on the fact is like what happens if this ends. I heard someone say once upon a time that operating agreements are not operating agreements, they're disoperating agreements, because that like what happens if everybody wants out, things go bad, things can happen. Like, because they outline, they say, like, I guess I could have never thought about it this way, like almost like in a prenup, what happens if everybody wants to go their own ways, right? And no one wants to do this anymore, whatever type of business it is, or in a real estate syndication specifically, doesn't want to exist any longer. And so that just determines who has access to what, who has rights to what at the end of it. And that's essentially what it's doing here. And then tax piggybacks off that.
Yeah, no, very simply, I like that disoperating agreement. I mean, that's true. That's a lot of what it is. It's a lot of explaining what we need to do if things don't go according to plan. So
Right.
it's a lot of what it is. I will say that another thing that is worth mentioning when we're looking at tax allocations and targeted allocations specifically is that in real estate, this becomes much more difficult to explain to your investors and comprehend as an operator, specifically because of depreciation. Because depreciation is what we call paper losses. They don't represent any real loss in economic value because, especially with bonus depreciation, you buy a building. Let's say you buy a $5 million building and you take $2 million of bonus depreciation in the first year. From a tax perspective, the basis in that building decreased by $2 million and it created $2 million of loss in the partnership, of tax loss. And for allocation purposes, we have to pretend, we have to go to make believe land where this building is now worth $2 million less than what you paid for it, even though we all know that's not true. But for the purposes of calculating these tax allocations, we have to pretend that's true and that the remaining economic value to distribute when you run that waterfall calc assumes that we're going to sell that building at a loss. So that's another really difficult part that creates challenges in explaining this to clients, explaining this to your investors. It's that depreciation component that just sort of disaligns this from reality.
Yeah, it's a great way to tie it back to last episode too, where we talked a lot about depreciation and like how depreciation and then partnership allocations to play together ultimately, because they are really important and they create like almost disunity, right? We're not just talking about taxable income for the most part, for at least for a lot at the beginning of a syndication, we're looking at losses. And so that's like going to be really important to the GPs, especially early on, and even the LPs.
Yeah, absolutely.
Awesome. Well, great stuff, Matt. I always appreciate hearing your wisdom on this. Next week, we'll be talking about deficit restoration obligations. So looking forward to seeing all of you pop in there. Matt, always a pleasure. And I will see you guys next week on the Major League Real Estate Podcast.